Up next on the SRI 360 podcast.
How will the world in 2050 look like? The world will be a lot more Asian, the world will be a lot more digital, and the world will be hopefully a lot more sustainable. If you want to be a leading sustainability asset manager, you need to have two things. You need better data. And second, you need a technology platform to manage this data, because the human brain can no longer handle the amount of information that you can find in the world between financial and non-financial information. We collect 150 million ESG data points, all financial information that we get. We have the AI platform that forecasts 30,000 equity prices every day. Based on all of this information, we don't have human judgment in the process. We have a data-driven approach. ESG is not ESG. Companies may be doing really well on issuing green bonds, but at the same time have a business model where some investors would say, actually, that's not green. I always say 95% of the economy is olive. It's neither brown nor green. It is somewhere on that spectrum.
The SRI 360 podcast, presenting world-class investors and experts, passionate about improving the world and making high-performance returns through unique ESG, impact, and socially responsible investments. Here's your host, Scott Arnell.
Hey everybody, today I'm speaking with Daniel Klier, and that's spelled Klier. And Daniel is the CEO of ESG Book at the Arabesque Group, which is a global group of financial technology companies offering sustainable investment, advisory, and data services through their advanced ESG and AI capabilities. Prior to joining Arabesque, Daniel was global head of sustainable finance for HSBC, where he developed the global climate strategy for the bank and led the development of the sustainable finance business across the corporate bank, the retail bank, and the asset management business. He joined HSBC in 2013 as group head of strategy in London after working 9 years as a partner at McKinsey Company. Daniel is a member of the board of Sustainable Energy for All, and he has also chaired the Bank of England Climate Risk Working Group and the Sustainable Finance Working Group at the Institute of International Finance. I have focused this discussion on the Arabesque S-Ray services, which was one of the first ESG data providers in the business. This has since been rebranded to ESG Book, which is the business that Daniel leads. So remember that when we're talking about S-Ray today, we're talking about what is now called ESG Book. I really enjoyed getting Daniel's perspectives, and I think you will too. And now, please meet Dr. Daniel Klier. So you're in London now, and it seems like you've been for a while, but your education looks like you went to St Gallen, and your accent doesn't necessarily sound like you grew up eating fish and chips and black pudding and things like that. Are you from Switzerland or?
No, I'm German. I'm from Munich, more specifically. I grew up in Munich and did St Gallen and a bit of London, and then spent the next 10 years between mostly when I was at McKinsey, Berlin and Hamburg, with a bit of New York. And then I moved to London when HSBC found me.
Why St Gallen did you choose that for university?
Well, St Gallen was, it was always sort of quite well known as a good business education, especially sort of in the German-speaking region. And so I think a bit by accident, I liked the fact that it was sort of not too far away, but at the same time in a new country.
What was it like growing up in Munich?
Lovely. Munich is a fantastic place. If you think about the places with the best lifestyle value, family value, Munich is perfect. It's big enough to have everything, but small enough to get around. You're next to the lakes. You're in the Alps in an hour. You're in Italy in 2 hours. It is wonderful. It's just quite small and conservative. So
it's a beautiful. I've been there many times, but living there is always different. Is your family still back there?
Yeah. And for me, living in Berlin was very important in my 20s. Right? Berlin was just the opposite. So I was that young consultant at McKinsey, flying business class all the time, and you feel really important. Then you come to Berlin, and nobody gives a damn. Right? It's like what? You have to get up in the morning to go to work. What do you do? It was very healthy. It was very healthy to ground you, which I think is really, really important in your early 20s.
Yeah, well, Berlin's a great place, I think, especially even for that time of your life, And so then you went and pursued a master's at the London School of Economics.
So that was part of St Gallen. They had a joint program.
Oh, so that was a joint program? That's very cool. And then when you were at McKinsey, which we'll get to in a minute, you ended up going to Colombia.
Germans are obsessed with doctors. So I did a PhD with two universities. One is University of Dortmund, because I found a fantastic professor there who liked the topic. And the other one was Catherine Harrigan at Columbia. She did a lot of the sort of diversification research. It was PhD. McKinsey gives you that wonderful option that you work for 2 years as a fellow, then you take a leave of absence, you write your PhD, and you come back.
So then you started your career at McKinsey. What did you do there? You were there a while.
I did a good mix of banking, because financial services, because everybody needs a good industrial home. And as a sort of economist by training, it was a good home. But I always enjoyed the slightly more entrepreneurial ownership mindset. So I spent a lot of time building McKinsey's private equity practice in Europe. So I worked a lot for some of the big American and European buyout funds, private equity funds, from everything from due diligence to then portfolio work, which I always enjoyed, because smart people, ownership mindset, fast turnaround, and you learned about completely new industries in a week, right? So I think my favorite due diligence was still a due diligence on the world's largest playground equipment manufacturer. So you have to work out how many slides will the world need in the next 10 years. And it's just fun. I love that. I love that kind of stuff.
Did you work in PE the entire time of your tenure?
Yeah, I did 50-50 probably between financial services and private equity. I worked for some large investment banks and then for some of the large PE funds.
And then around 2013, you went to HSBC as group head of strategy. So I guess the first question is, why did you want to leave McKinsey and go in-house somewhere? What was the genesis of that? Because after all, I think you were a partner at McKinsey, and that's not necessarily an uncomfortable thing at the end of the day.
You did your research well. I mean, for me, I always thought about sort of my career almost in decades, and now sort of being another decade on, that sort of confirms it for me. I think to grow and to learn, you need to change environments. And McKinsey was a fantastic place to learn, and I learned a lot. Once I was a partner, I felt like I learned tremendous amounts, but you almost need a different environment to continue your development. As you said, I think it's a very comfortable place, and I love the firm, but sometimes you need to change something to actually become the next best version of yourself. And I mean, at that time, I had no intention of leaving, but as it sometimes happens, a headhunter calls you and you say no, and then you ask the questions of what it's about. And then they said it's head of strategy for HSBC. And I said, well, let's talk. I had 25 interviews at HSBC because it's a very consensus-driven organization. But in the end, I met Stuart Gulliver, who was CEO at the time, and just a fantastic leader, very inspirational person. And for me, it was clear that's what I want to do.
And then as head of strategy there, what does that really imply, or what were your challenges at the time?
Yeah, I mean, it's very interesting. HSBC, as you probably know, went from being the world's local bank to a bank that was a lot more focused on its international footprint, the ability to connect trade and capital flows around the world. So a big part of this was changing a strategy which was really focused on planting flags around the world to a strategy that actually unified that model and delivered the benefits that you can deliver when you're in every part of the world, especially when you have that big Asian footprint. So things ranged from your overall capital allocation and how do you think about what businesses to sort of invest and maybe underinvest a little bit, to driving innovation of sort of launching new digital platforms and launching a wallet in Asia. And in the end, I got into the whole sustainability area through strategy, because Gulliver asked me in his last year as CEO, how will the world in 2050 look like? You can do a lot of McKinsey analysis, but in the end, you come up with three answers. The world will be a lot more Asian, in particular a lot more Chinese. The world will be a lot more digital, and the world will be hopefully a lot more sustainable. And on the back of that, I had a new job on my desk, which was, can you build me a business around sustainability? And that's what I did then since 2017.
You're looking at the trends of the business and got asked to build a business, and then said, I think I'd like to run that business.
It was strategy driven. I always had an interest in being a bit more entrepreneurial. So I think it was bringing together the very strong belief that this is the start of a fundamental change in the financial system. I wrote my own job spec as head of sustainable finance. I think I was one of the first in the industry at that point. Now everybody has one. So it was fun to see something that will come, And on the other hand, it was great to be able to build a new business within a firm that has a balance sheet of 2.7 trillion.
You ended up somehow moving to Arabesque Asset Management as president of Arabesque and CEO of Arabesque S-Ray. So it sounds like a dual role, which of course is the meat of what I wanted to talk to you about today. How did that move come about out of HSBC?
Yeah, I mean, as you, I think, suspected, there's probably, again, two things coming together. One, it's 1 decade on. So I think after almost 10 years at HSBC, close to 10 years, it was quite clear to me I've now learned how to operate in a very large global organization, which gave me a lot. I learned a lot. I benefited a lot from it. But I knew for my own development, I needed something, again, different. But then more importantly, it is just so clear the entire industry will need help. And really, Arabesque for me was an interesting platform between ESG, sustainability, data, and technology to essentially enable the industry. I mean, the way I think we want to position Arabesque is be the sustainability engineers behind the industry.
Can you explain this dual role that you have?
So Arabesque was originally founded as an asset manager, but then fairly quickly realized that if you want to be a leading sustainability asset manager, you need to have two things. You need better data. That's when this business, Arabesque S-Ray, was created, focused on ESG data. And second, you need a technology platform to manage this data, because the human brain can no longer handle the amount of information that you can find in the world between financial and non-financial information. That's when the AI platform was created. And so the one role that I have is to lead the data business, because obviously the data business will be a huge component of any sustainability transformation. But then second, which we mean that with the president of the group, is really help pull together the bigger narrative of how we are, I think, as a group, help reshape the financial system, hopefully positive way.
You're running the data business, but you're also on the asset management side.
I'm sort of president of the group, whatever you call it. I think it's a bit of a deputy CEO to help pull together the bigger narrative. Because if we as Arabesque are successful, then I think we are successful as a group that mainstreams sustainable finance. And we can do this with investment solutions, with data solutions, with technology solutions. And essentially my president role is to make sure we have one narrative, one face to the market. We tell one investor story.
Maybe you can give me a high-level overview of Arabesque. Maybe describe the main businesses, because you've got a few, what your mission is at the 10,000 meter level right now, to frame everything else that we'll discuss.
Very, very clear. Our mission is to mainstream sustainable finance. And we do this, I think, we have three businesses. We have an investment management business, an asset management business, where we produce funds, create funds, anything from ESG funds to very specific climate pathway funds. The second is we have Arabesque S-Ray, which is a data business. So we provide ESG data and analytics. If you are an investor and you want to know your climate alignment, we provide that. If you are a big pension fund and you want to understand your exposure to human rights risks, we provide that information. And the third one is an AI platform, which is a platform that allows you to customize investment strategies. So you want to say, I want to invest in global equities, but I want to exclude certain things. I want to overemphasize companies that are 1.5 degree aligned. And the AI platform calculates the strategy for you, but also runs it on a daily basis. Those are the three platforms that we provide. So investment products, data, and a technology solution to make sustainable investing something that is ready for the mainstream. What might be helpful is that the asset management business was created in 2013. The data business is 2 years old, and the AI platform is 1 year old. That gives you a bit of a sense where we are on that journey. The data business had a big Series A 1.5 years ago, with people like Allianz coming in, DWS coming in, Accenture coming in. And the AI business is the most recent, with a Series A with DWS as an anchor investor.
So these two are smaller piece of the overall business, primarily because of the length of time.
Age.
Right?
Of age. But certainly are the ones that are growing faster, because data and technology is really, I think, now the fuel for the industry.
On your asset management side, how many funds do you have?
So we run a number of, obviously, So special mandates, SMAs for individual investors. And then we have 3-4 larger funds. One just launched 3 in the market, but I think we do a lot more work for individual institutional mandates.
Am I right in thinking that originally the firm started out as a Sharia compliant investor?
It had an element of it, but it was really started out as a responsible investor. And Sharia compliant is actually a form of responsible investing. Faith-based investing has a strong element of responsible investing.
But it's specifically not equities, no?
It can be equities if you adjust the payment profile.
But at this point, do you still have a Sharia compliant component, funds managed in that way, or has the firm moved on in that regard?
Faith-based investing is an important part of our strategy. Actually, one of our board members is Caroline Wu, who was the CEO of the Catholic Relief Fund. And so we have other faith-based solutions, and we have Islamic finance solutions, because it actually is a very important element of how you think about exclusions. We do have Islamic products.
If it started out that way, there was a pivot to more broad-based ESG at some point, or maybe this is all before your time.
Maybe this is all before my time, but the firm, as I said, started in 2013. In 2013, very few people talked about ESG and sustainable investing. That clearly became now a much bigger topic, but the asset management business is really now much more of an enabler of the other businesses. I think the two interesting platforms is AI and the sustainability data business. The external investment came in. Those are separate companies as well. I think that's really the interesting. So if you think about the transition from an asset manager to essentially a fintech, that's a transition that we're going through. And that's a bit what I came in for to do as well.
Can you explain in plain English what quantitative investing is and how that investment philosophy approach is different from other investment strategies?
Well, I think the main thing is that we don't have a human bias in our sustainability decisions, right? So everything that we do is purely data-driven. We collect 150 million ESG data points, and we combine that with all financial information that we get. And so we have the AI platform that the team has built, forecasts 30,000 equity prices every day based on all of this information coming together. So we don't have human judgment in the process. We have a data-driven approach. Every score that we build is purely data-driven. And if you are a large company, if you want to understand your ESG score, you can double-click and you arrive at the raw data. If you are an investor and if you want to understand what drives your investment choices, there's an algorithm behind that combines financial and non-financial information into an investment solution. That's in the end what we think is the future of investing, because you went from active to passive. Now you go from passive to almost autonomous, right? Active is coming back.
Do you believe that we're moving to a better place where computers can analyze millions of data points per second? Does identifying sustainability outperformers always lead to share price outperformance?
I don't want to make it too complicated, but I think that there are two ways to think about ESG and investment decisions. One is you define outcomes, right? So you say, actually, I want to optimize my investment strategy for a certain outcome. And the outcome can be a financial outcome, but also can be a sustainability outcome. As an example, I want to build a portfolio that is aligned with net zero pathways. That is a fairly complex exercise, but essentially you build a portfolio of companies that have a pathway that gets you to net zero by 2050. There, you don't try to pick companies that will deliver better performance because of sustainability, but you pick companies that deliver a certain outcome. The other one is, in fact, you use ESG data to predict outperformance. Models and machines can deliver both for you. Many investors, I think, want the former rather than the latter. They want to use data models to make sure that we deliver certain outcomes. The track record on companies delivering better share price performance is still very young. I think all the data points that we see, and I did that also in my old HSBC shop, if you look at the time series over the last 2 to 3 years, you start to see companies with a better ESG profile actually deliver better performance. But very often, if you go the level lower, it was driven by singular events. So over the last 18 months, companies with a better ESG profile did outperform the market, but the main driver was the oil price. You can make that big narrative about ESG, but at the moment, you still often can trail it back to the singular macroeconomic events.
What's the backstory on the quant rules, right? The fundamental work of an equity investor is to analyze a company, you evaluate management, you evaluate sustainability. But in a quant fund, this is all done, I guess, automatically by a machine. But what's the research behind that? I guess you have to do regression analysis on what's driving share price performance. How are the rules selected that go into the algorithm? And who writes the code for that? I guess it's not you. But what's the feedback loop? Can you make that real to me?
That's the really interesting bit here, right? Because essentially you move from quant to artificial intelligence. And what artificial intelligence does is it builds patterns, it recognizes patterns, and it learns all the time. So we have 30 data engineers that are all imperial PhDs. You don't build a singular quant model that then runs for the next 20 years. You actually allow a machine to recognize patterns. On the AI platform, we have the first funds live. It outperforms the market at the moment. We take every information in, financial information, analyst forecasts, weather patterns, and you look for patterns, pattern recognition. It's like your regression model, but performed by 20 million machines every day.
So could you tell me how the investment process works or looks like in practice, and how do you incorporate your S-Ray data in the investment process?
So it's included in two ways. So what the team has built essentially is a artificial chief investment officer. We call it ACIO. And what it allows you in the first step is to customize your investment strategy. And you go through all the different steps. You want to do long only, long short. You want to do global equities. You want to do all the sectors. And you also in that process define what are your sustainability criteria that you're going after. And that's the first place where our data comes in. So you define the boundaries. You may have seen Morgan Stanley just bought Parametric for, I think, 7 billion, because it is very clear investors increasingly want customized investment strategies. So that's step one. Step two is then where the artificial intelligence platform actually runs your strategy. And given that it's not managed by a portfolio manager, but by a machine, you can run as many strategies as you want to because it's definitely scalable. Mm-hmm. And that's where the machine forecasts 30,000 equity prices every day. And if you want to, gives you a daily signal how you change your capital allocation. And that's the second point where the S-Ray data comes in, because sustainability information is just another data point. That is just another data point where you look for patterns. But it's not just sustainability data. Obviously, it's all fundamental data that you have in the market.
So it not only establishes your universe, it also does your portfolio construction.
And it aims to generate alpha by taking information into account in history you wouldn't. And for the human brain, it's quite hard to digest.
You have different things like F score and G score, earnings, pressure, momentum. These are all parameters that customize your construction of the portfolio.
Yeah, so the customization can be as simple as it should be for a less informed investor, and it can be as sophisticated as you want it to be if you're a very professional hedge fund manager. So it goes to all the fundamental risk metrics. You can define every parameter of your portfolio. We have a lot of sort of guys that used to be in hedge funds before and essentially applied the same methodology here. The engine essentially is the engine. The question is, how many customizable options do you give people? And it would be very different for a wealth management client who essentially wants to say, what are your sustainability beliefs, to a very sophisticated portfolio manager. At the moment, we have a few funds on the platform. One is with DWS, where we have a co-branded fund with DWS, which is the Arabesque DWS AI ESG fund. That obviously doesn't go into all of these details. It's a much more consumer-friendly fund. But if you are a very sophisticated portfolio manager, you can use the platform to define whatever you want.
If you're providing this data feed and you sell the same data feed to third parties, my question is, how would your portfolio at Arabesque look any different from any other quant fund that's using S-Ray?
It's two things. One is data is only data, right? So data needs to be interpreted. And I think that the first instance is you define what outcome you want. Right? With sustainability, there isn't a single interpretation of what is good sustainability and what is bad sustainability. You need to interpret which part do you want to emphasize. So a big part of the data that we provide is really used to screen your portfolio, do preference filters. That's where the Islamic element comes back in. You exclude certain activities that you don't want. And that's what data is used for. And the second one is obviously then what you feed into an algorithm. And it's as good as your algorithm is. It's as good as your machine learning programs are. And that's where I think the arms race will be for many of the technology firms.
If this is so valuable, why would you sell it to third parties when you could use it and keep it proprietary in your asset management business? Is the idea that this would be more profitable to be a provider of this business than actually the asset management?
So my view is, and I think our view is, that the financial services industry, as you know, is the most fragmented industry in the world. There are thousands of banks, thousands of insurance companies, thousands of asset managers, thousands of asset owners. Very few of them will be able to develop their own tools, data sources, data models. And so everybody will need help. And I think that is really where we want to go. We want to be the engineers behind the industry that helps others achieve sustainability outcomes. You also know that the entire industry is facing incredible cost pressures. So people will need to look at technology to replace essentially what often today people are doing. And therefore bringing better data and better technology in to solve a quite fundamental problem where you have to deliver on your commitments, you have to manage future risks, you have to comply with regulatory solutions. Everybody will need help.
Would it be possible that you could describe a sample investment and how it was scored? How do you actually get from this idea, yes, we want to be sustainable and responsible, down to buying a stock? How do you select that? Somehow I'd like to maybe make it less like trying to pick up a fish, just as an example.
Maybe we start on the more how you actually assess a company for sustainability, because I think that's the first important piece. And obviously, sustainability means many different things for different people. So we start with two data sources. We start with information that companies disclose. So we collect about 450 ESG data points on 7,000 listed companies in the world. That ranges from everything from your greenhouse gas emissions footprint to the number of women you have on the board. We then build that up into a data model that gives you scores, right? It gives you an ESG score. It gives you a global compact score. An ESG score is more to find out companies that do things well. A global compact score is more to identify companies that are exposed to certain risks, labor malpractices, human rights risks. We then have a product like a temperature score, where we combine all of that information with temperature models, where we take the IEA scenarios and essentially model which company is actually aligned with different pathways. And you can work out, is a company actually aligned with a 3-degree world, a 2.5-degree world, a 2-degree world, or a 1.5-degree world. And then we use that information to help investors essentially get transparency in their portfolio, but also construct portfolios. So we build indices for certain investors and say, if you want to build an index, a portfolio that is aligned with 1.5 degrees, what stocks do you pick? And then you let it run. We essentially take a universe of 150 million data points, build it up to company level indicators, and use that to inform investment choices.
When we're talking about public equities and trading public equities and sustainability and all that, how does asset management buying and selling shares on the secondary market change corporate behavior? Is it through stakeholder engagement, or do you think you get there through capital allocation? Because theoretically, you're buying and selling shares. It's not an IPO, right? You're on the secondary market. So that's a question I get asked a lot, and now I'm asking you.
I think it's really 3 ways that we and other investors deal with this, right? The most traditional way is exclusionary approaches, right? You just say, I don't buy certain activities. And with that, you restrict access to capital. You've seen a few industries that went through this. The tobacco industry certainly went through this. You currently see certainly coal go through this, and increasingly the broader fossil fuel industry, right? And that is a concern for companies, because it means actually they're restricting really the access to liquid markets. The The second approach then is stewardship engagement. You use your ownership power to actually express preferences at AGMs. That's why obviously all the proxy voting companies are increasingly important and look at real data. That's why shareholder stewardship and engagement from the BlackRocks of the world is increasingly in focus. And the third approach is, let's say, positive discrimination, right? You build investment products that overemphasize companies that have certain characteristics. And again, it's the opposite of the exclusionary approach. It allows you to funnel more capital and therefore, in an ideal world, increase share price of companies that have certain characteristics.
Yeah. Well, the first and the third item you mentioned, no doubt, that's the main thing that you guys are doing with your S-Ray data. But do you have an active shareholder engagement program at Arabesque?
We do it for our own asset management business. Yeah. But as I said, I think as a company, we're shifting much more from the asset management business to actually be the solution provider where you use better data to make better informed decisions. So we are the providers for people like GPAF, the big Japanese pension fund. If they get to vote on things in a different way, that has a lot more impact than if Arabesque does it. We do all three things, but I think the power for change that we have is actually a lot more by providing our information to others.
We can't have this discussion without bringing up greenwashing. What does greenwashing look like to you in the current ESG public equities landscape? And how do you protect against it, especially in your data feeds? Because you explained earlier that you eliminate human bias because you've got machines doing this. And on the other hand, data by its very nature is backward looking, right? But temperature, score, and climate change is necessarily forward looking. So how do you ensure your algorithm is somehow forward looking and not purely based on backward looking data? Because if BP is investing 500 million pounds a year in renewable energy, what does a computer do with that information? Humans can be nuanced. They listen to management plans and then they can either believe them or not, but machines don't.
Maybe 2 or 3 different perspectives on this. The first one is, I think one of the reasons why greenwashing is such a big concern in the industry is because people have very different definitions of what is sustainability. When you say you want to be the leading sustainable asset manager, and for you that means integrating ESG criteria, that can mean something very different than somebody who hears this and thinks you're really interested in climate change, right? Take Tesla as an example. Tesla is very good on climate because they build essentially electric vehicles, and it's probably the worst company on governance, because they have an interesting character who dominates the firm. And so if you look at it from a sort of broader ESG score perspective, you would come out with quite a mixed profile. But if you want to have somebody who actually interprets sustainability as climate, you really want a lot of the Teslas in your portfolio. So I think one of the reasons is people use very different languages to express different things. The second problem is that, to your point, yes, commitments and targets are really important, but the only way to work out whether somebody is delivering on commitments or is just making commitments is to put data behind it, right? And so, yes, data is backward looking, but what data allows you to do and what the big objective is to evidence progress against the commitment. And I think that's where you work out whether companies that stated certain things are actually year by year making progress against. Clearly, data is still imperfect. Data is getting much better and transparency in the industry is getting better. And therefore, you can actually measure alignment to certain targets.
So while we're on data now, let's drill down a little more on S-Ray, which is more your passion. How does it differ from competing ESG data providers?
So I would say different in 3 things. One is sustainability is all that we do. So we have 250 people. We just do sustainability. So we have people that just build models. We think we build better analytics. We build better insights into sustainability. Like the temperature score, which was a thing that essentially we invented. Now the entire industry uses it. Second thing is we have, I think, a more transparent approach. The big criticism of some of our competitors is always that the ESG score essentially is a black box. It's very, very heavily driven by controversies. It's very heavily driven by negative news. And therefore, for a company to actually understand what drives the ESG score is very, very hard. I mean, in my old HSBC days, we went in 1 year from fourth quartile performer to a top quartile performer. Have we changed that much in 1 year? Probably not. And the third reason is we deliver it with a better technology. Our technology is built in this decade, is built in the cloud, it's flexible. It is very different than if you built your business model 30 years ago. We all know that what legacy business models are great, but also much harder to bring along. So I think it's that combination. I think better insights and really sort of market-leading analytics, more transparency, and a better technology.
You mentioned the transparency. You feel like some of your competitors are black box. Can you give me an example where you feel S-Ray is more transparent than, you don't have to name names, but...
Yeah, without naming names, I think all of the big ESG ratings at the moment have a very, very strong weighting to historic controversies, right? It's very heavily weighted by how many NGO claims did you have against you, how many past litigations did you have against you, which is helpful and is important to identify risks, but it's very hard for companies to actually say, this is my ESG performance and this is what I can influence. What we do is we have a purely data-driven approach. You can understand every data point that goes into the ESG score, and therefore you can argue for or against, but you argue on data that is on your website that you disclose in your ESG report. And that's something investors really like, and it's something that companies really like, because it makes it real and it connects it with real evidence.
And you're saying a lot of your competitors, you can't see that. You can't see what's sitting behind.
Yes, and it's partly because they may address a slightly different purpose. If your main mindset to ESG is to avoid significant reputational risks, then your main interest is to avoid big scandals. Then actually historic litigation and the like is really important. But if you want to use data to essentially pick companies that are future winners, pick companies that are delivering on certain promises, then you actually want to get into the real underlying indicators, KPIs, use that to create new financial products and the like.
Can you explain this ESG book initiative? I came across that somewhere on your website, and it's described as like a flagship initiative for the future, and it's something about connecting market stakeholders. But honestly, I didn't quite understand what it is and what it's going to do.
Yeah, you're very well informed. So ESG Book is an initiative where we want to create a transparent ecosystem for ESG data. We're doing this together with the IFC as a core partner in this. And without saying too much at this point, it's essentially a new platform that creates an ecosystem for non-financial data. The way I describe it to the team is it's a bit like Netflix that started with sending out DVDs and ended up with a streaming platform.
Yeah.
For us, ESG Book is a bit like that. At the moment, we provide data to investors. In the future, we want to have a platform where investors and companies can actually engage on non-financial matters, on ESG data. And that's the vision for ESG Book. That's something we're working on for later this year.
So when will it be launched, or is there a date that you're shooting at? Or?
Later this year.
I wanted to understand if you believe that policymakers have the most important role in driving market behavior, or do you think that the markets can be left to allocate capital sustainably to get to net zero? There's some bit of a sense that within the market that if we just implement sustainability lens, let the free market, it'll self-correct and solve everything. And I think I saw somewhere that you produced a report that only 25% of corporates are on the pathway to 1.5. And I guess that's because maybe currently there's no real sticks. There's carrots, but no sticks out there. So does this need to be led by central bankers or policymakers and not investors? Or are we going to get there with carrots, I guess?
I think it will only work if you have both. I think the role of policymakers is twofold. One is to harmonize metrics. It's a bit like in the 1930s when a P&L wasn't a P&L, right? And it's very hard to compare profit if you don't have a standard definition of what is profit. So I think harmonizing disclosure it's really important. If you look at TCFD reports of two companies today, even in the same industry, they say completely different things. So as an investor, if you don't have good signals, it is very hard to reallocate capital. We're doing some of that job for investors by harmonizing data, but it would be much easier if you actually have standardized data sources. And people like the IFRS Foundation are now picking this up to increasingly include this in disclosure standards. The second role for central banks and for policymakers is to ensure that the financial system appropriately prices for risks, right? That's where Mark Carney's strategy of the horizon came in, where I think the Bank of England evidenced that essentially the financial system is mispricing future risks because it finds it hard to price risks that haven't occurred historically. And that's where now climate stress tests and the like come in. So it's not trying to make judgments of whether a financial actor is doing the right thing or not. It's trying to take a belief into something that he can actually run as a scenario, put into numbers. And if you're not prepared for it, hold more capital. And so I think that is the element of the stick then is, are you able to manage possible future outcomes? And if you're not, do you have enough capital to manage this? The financial markets, I think, have a very important role to play to drive that allocation of capital, as you say, the carrot. Right? And I mean, just the fact that, coming back to our Tesla discussion, that Tesla is worth more than an entire sort of global automotive industry together only makes it very clear that there's a real incentive for companies to find future-proof business models, create some investor fantasy. And I think so therefore the combination of the two is really important. I mean, as I said, I'm German. If you look at all the German car manufacturers, they have the stick is regulators increasingly banning the sale of new cars with internal combustion engines. The carrot is, if you want to get your share price to interesting levels, you need to paint a positive future. In the car industry, the future is now electric. And so I think it's a nice example where the carrot and the stick starts to come together.
So you firmly believe there needs to be sticks in addition. There's already carrots, but we need to have more sticks.
Sticking to the climate discussion, right? If we believe that we have to reduce carbon footprint by 50% in this decade, you probably need policy signals. Just investor commitments will probably not make it. You need a combination of both. You can't have only one of the two. But I think policymakers have an important role to set signals. If you think about the success of solar and wind, a large part of that was driven by the German government when they started the Energiewende, where they put a level of subsidy in to make renewables competitive. And sometimes you need that policy signal to actually get a movement going.
If you had to name the one most important challenge in the ESG public equity space at this time, what would it be?
I think the biggest challenge is that everybody talks about it, but not everybody means the same thing.
So we need more clear language, common language.
Common language, clearer definitions, a move from a marketing narrative to something that's a lot more tangible.
What do you know now about ESG investing that you wish you knew in 2017 when you became the global head of sustainable finance at HSBC?
Mostly, I think, how long it takes to take a senior level commitment through an organization. What we're really talking about is we're talking about system change, right? And if you can only change the system if you change every moving part of the system. The way you measure, the way you incentivize, the way you report, and the complexity of integrating ESG properly in the system is something that I think we all underestimate. In most organizations, this started as a side department that was doing ethical investing, sustainable investing. And now everybody is moving that side department into the core. But to get into the core, it's a fundamental change where you need to change every part of the system.
Getting everyone on the same page. I'm particularly interested in not naming names, but an investment that appeared to tick all the boxes at the time the decision was made to invest in it, but it didn't turn out. And what was learned from that experience?
I would probably more answer this in probably two different things. One is on sort of bigger thematic decisions, time horizon is the hardest here. Yeah. I think everybody knows and believes in we will have a hydrogen economy and it will come. But when it will come, very hard to judge. So many people made, I think, wrong investments in hydrogen, not because they invested in the wrong companies, but they invested too early. And I think the second one is, back to my first point, ESG is not ESG. You can have the same company looked at from 5 different lenses, and you will look at it with a very different sustainability lens. That often creates conflicts where companies may be doing really well on issuing green bonds, but at the same time have a business model where some investors would say, actually, that's not green. And I think those are conflicts that will be with the industry for a long time, because I always say 95% of the economy is olive. It's neither brown nor green. It is somewhere on that spectrum.
If someone wants to get into the sustainable finance space, how would you advise them to get into the business?
I mean, first of all, it's now, I think, everywhere, right? It's no longer a little side activity. You have it in your sustainable supply chain teams, in your bond teams, in your asset management teams. So I think the first important recognition is it's not something that you need to join a certain team, but it's part of every line of business increasingly. I think the second is bringing together financial know-how and sustainability know-how, which not many people have. You can approach it from either end, but you need to build the other capability. You can be the best sustainability expert if you don't understand financial markets, no chance. And you can be the best investor if you don't understand sustainability, you will fall short. And so bringing in that combination and building your skill set through academic experience and real life experience, I think, is key. And third, frankly, this is still such an evolving field. One just needs to get started.
Daniel, I really enjoyed meeting you and enjoyed picking your brain on this stuff and trying to understand. I've learned a lot. But I really appreciate you taking the time and appreciate you supporting the project. It's been really, really interesting. So thanks very much. Cheers.
Cheers. Bye-bye.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.